Friday, March 6th, 2026, Maneco 64, home of alternative economics and contrarian views. Well, it's nice to have you back, Clive, on a Friday. I don't think we've spoken on a Friday for a while. How are you?
Hello, Mario. At least I've got something growing. It's not my stocks, it's the garden. So that's nice.
Yeah, I mean my stocks as well, my miners they've come off the highs, but I wanted to talk to you initially because I've kept on paper like the end of year data and performance for like gold, silver, and all kinds of assets. And I was looking this morning from like yesterday's close that the Dow is year to date down 0.23%.
That's right.
S&P is down 0.22. Nasdaq 100 is up 0.74. The TLT, which is ETF based on longer term treasuries, that's up 2.02%. So it's eking a gain. The medium term ETF, it's called the IEI, that's up 0.07%, so virtually unchanged. That's for treasury paper from 0 to 1 year, so T-bills. Dollar index is up 0.72, so slightly higher on the year. But what I see here, Clive, is the trend from last year where gold, silver, the miners, and commodities continue to outperform. And I think the 60/40 portfolio is becoming more and more irrelevant. And I have to give credit to Morgan Stanley for changing it to 60/20/20, but I still think they're keeping too much in general stocks because gold, and this might have changed a little bit uh, when you watching this, because I took this at a price of 5,116. So gold is up 18.35%, Clive, with silver at 84.27. Silver's up 17.63. Yes, underperforming gold slightly. GDX is up 18.7, GDXJ 20.7, SIL 23.35, and SILJ up 25.39. So I know that it feels a bit bearish and the sentiment is kind of low for precious metals and miners, seeing what we did in January. But compared to the rest of the market, still doing great. And the Bloomberg Commodity Index, Clive, is up 15.6%. So I like your opinion on this because that was your business for many years, advising private clients on where to put their capital.
Well, Mary, you're spot on. I mean, what we're seeing this year is, broadly speaking, a decline, albeit very minor, in equity markets and a rise, quite substantial, in commodities. Anybody who follows my webpage, clivethompson.com, will see that each year I publish what's called an asset allocation table. And I publish that sort of late October, early November for the following year. So the one for 2026, I took down, I significantly reduced the exposure to equities and increased the exposure to precious metals. Obviously, that turned out to be a very good move, given what's happening. I think what's going on now in the world is that portfolio managers and economists are starting to reassess to what extent they hold equities, bonds, and commodities. And the trend, I think, is in the direction of increasing the exposure to commodities, commodity companies. So within the equity side of the portfolio, I think we're going to see a drift. It'll be minor, but it'll be more than zero in favor of commodity companies, and that would include gold and silver miners. and probably away from the technology sector. Again, the move so far has been very, very slight, but we can see that they're all these tech stocks are well off their highs. When I say well off, we're talking a few percent, but in stock market terms, that's quite a lot, really. And we've seen the precious metals in particular up substantially since the 1st of January. But yeah, sure, they're down since the end. Sorry, up substantially the 1st of January, but down somewhat since the 31st of January. But I don't think we'd look at the sort of recent trend of the last month of February and say, okay, we'll project that into the perpetual future. All the things which drove precious metals to all-time highs in the month of January still exist. The concerns about the levels of national debt, the concerns about the amount of money being printed, and of course we've now got an extra factor, which is we have a war situation. And in a war situation, it means the governments tend to spend an awful lot more money on defense. We call it defense as opposed to attack, which is what it really is. They spend a lot more money on defense, and that can only do one thing: it can add to the national debt. The other thing we've seen as far as the United States is concerned is President Trump's tariffs have been struck down by the Supreme Court, and they've been ordered to refund those who paid the tariffs. Now, he's got a temporary arrangement in place for 150 days where every country is going to be taxed at 10%, and we don't even know if that's legal yet. But obviously, the amount of tariffs that they thought they were collecting is going to be significantly less than the numbers originally touted. As they start to refund these tariffs, it's obviously going to, once again, with the combination of war, tariff refunds, it's going to increase the national debt, pushing those numbers closer to the end. And I think as national debt goes up, it's obvious that nations around the world are going to want more gold.
Yeah, and also the war spending. That's going to increase the deficit. And if it keeps dragging on, and I know we weren't around in 1914, Clive, but I've read a lot about when it started, World War One in July, end of July. The narrative was that it was going to be over by Christmas 1914, and we know that wasn't the case.
Yeah.
I forgot to mention Bitcoin, Clive. Year to date, it's down 18.74%. So I guess that's one of the, I think that's the worst performer of the major assets there.
Yeah, I mean, I don't want to make any comment or price prediction on Bitcoin because it's an extremely volatile asset, and it has proven historically that it always does the opposite of what people expect. So, when people
Yeah,
are
no,
bearish, it turns around. So, yeah.
I'm just mentioning that it isn't doing well. I'm not trying to slag anyone off or
So,
anything. But
I have historically made a couple of predictions of Bitcoin, but they were positive and at much, much lower prices than today. But I'm nervous about making any prediction at today's
yeah,
price.
yeah. Um, we're almost, well, we've got like 3 weeks or so until the end of the quarter, first quarter. I know a lot could change in terms of the performances we've gone over, but what's your experience? Because you've been around managing money for decades. What's your experience of how assets perform, like compared to how they have done in the first quarter? There is an old rule of thumb, I think, that says whatever stocks do in the first month of the year or whatever, that's how they're going to do for the year. Any opinion on that? And also, Clive, would you think about increasing the allocation towards precious metals for your 2026 portfolio, or is that something you won't do?
Well, first of all, the first quarter performance and the way things tend to perform. I know there've been a lot of studies about the what's called the calendar effect, where it proves that certain months historically been better than others. But let's put that to one side and talk about my personal experience. Here in Switzerland, and I've been in Switzerland almost the entirety of my career, we have something called your annual bonus. They more commonly call it the 13th month. So the 13th month is kind of like an extra month's salary, which is paid out, and it's generally paid out by most financial institutions, at least it was in my case, in March. So you get like an extra month's salary. If you were a good boy the previous year. And what's a good boy means? It means following the law, complying with the rules, and turning up for work, basically. The rest is sort of very fudgy, but it's not particularly related to sales or anything like that. Now, one of the great things about getting your bonus in March was you'd immediately say, great, I've got some money coming, and you go and invest that extra month's salary into stocks. And I can tell you, sod's law seemed to be almost the day we'd finished investing would be the day the market started going down. That's just personal experience, and I can't say that's statistically true. It's just the way I remember it. And but then on the other hand, you're thinking, well, if I get my bonus in March, perhaps I should wait till June to invest it or July or something like that. But then that really hurts because you're sitting on cash, you're sitting on a depreciating asset, and you think, no, I got to move it. So that's the fact on stocks. My experience is March is what do they do? They do say sell in May and go away, don't they? Yeah, I just thought of that. But so investing your money at the end of March in the stock market has generally been a poor choice for me. Now, talking about whether people should invest more in gold, it depends how much they've got. I'm certainly not a person who thinks you should have too much assets in any asset class, and that would include gold and precious metals. And I probably am comfortable where I'm sitting, which is, I would say, it's most likely around 25% now exposure to gold and silver. It started out at about 10, and it kind of increased because I never stopped buying, and it also kind of increased because the prices of things went in the right direction over the years. Gold has
Is
been one of the
that
better performers.
is that just bullion or all the whole sector?
No, it includes when I say exposure to gold, it includes the precious metals mining companies. It includes ETFs of the precious metal mining companies. It includes physical ETFs which hold physical precious metals, and it includes precious metals held by the bank in custody, and it includes that would be physical metal, and it would includes precious metals in account. So in Switzerland, you can have accounts denominated in XAU or XAG, just as I think Glint does that as well. But you can have your accounts dollars, pounds, euros, gold, and silver. They're all current accounts. And then the last thing you can have, two more things you can have. You can have the gold physically held by the bank in physical bars. That's allocated gold. It's not on the bank's balance sheet. It's custody for you. And the last thing you can hold, of course, is the physical coins and bars, which you obviously need to keep in a very safe place, but somewhere you can go and get them if you need to in a hurry.
So before we proceed further with the interview, I just want to give a shout out to Dirty Man Safe. So with traditional safes, their so-called advantage is that criminals can't break into them. But Dirty Man Safe is different. Its advantage is that it's undetectable, so they can't even try to break into it. And that's only one of the many features of Dirty Man Safe. They provide 3 different sizes, and you can bury your gold coins, silver coins, bars, important documents, jewelry, and anything that's valuable for you. So yeah, Dirty Man Safe is affordable, convenient, provides you peace of mind, confidentiality, and sustainability. So if you want to find out more, there's a link below in the description. It will take you to a landing page. And if you use that link, you get 10% off if you were to decide to buy a Dirty Man safe. And they ship it to Europe as well, not just the United States.
Free.
Yeah, yeah,
So I include all of that. All of that is in
yeah,
my
yeah, yeah.
25%.
Okay, good, good. Um, we know, I mean, there's the old saying about the fog of war, which is basically you can't really trust anything any side is saying about the results and what's going on. But this morning I saw a headline come up on my phone because I subscribe to Bloomberg, and Bloomberg is very mainstream. And they said, and I'll bring the article. It's slightly different than the headline that I got on my phone. It says Strait of Hormuz shipping sees near total halt as war in Iran continues. And the headline, Clive, was as the war is nowhere near, it wasn't a good headline. It's saying this is gonna, looks like it's gonna drag on for a long time. And it's not just the oil that comes through there, but also you've probably seen countries like Qatar, they've cut off the natural gas pipeline. And it reminds me a little bit of the 1970s when you had the oil embargo in 1973, and oil prices went from $3 a barrel to 12, and we had a massive stagflationary 1970s. So my question is, are they going to be able to avert the stagflationary environment? We know already that we already had a problem with inflation from the COVID era. They haven't really deflated the money supply. If anything, things are going up. I see the Fed's balance sheet, Clive. It's continued to go higher. They update it every Thursday night, and I've got the fresh numbers here. So here we go. I know it's come off a bit, but from here, but they started QE again, and they've basically done 100 billion. And I also saw that the U.S. Treasury, Clive, is saying they're going to intervene in the futures market in oil to try to keep the price down. Do you think any of that will work? And do you think we are entering a stagflationary environment? And very few people are aware of it. They're still focused on tech, and the general stock market, and not commodities. Maybe it's a little bit like in the 70s, before your time, but you might remember the Nifty 50s in the 70s. There was some like a tech bubble in the early 70s,
Yeah,
and that,
but yeah,
yeah,
Polaroid and the
yeah,
companies
yeah,
like that, and Xerox and stuff
yeah,
like
yeah,
that.
yeah. So, yeah, what's your view on the war and how it will affect? Will it be stagflationary? Yeah,
We're seeing this. Well, we're seeing the super tankers divert away from the Straits of Hormuz. They're heading towards the Atlantic Ocean now, looking for an alternative. And what super tanker owner would want their tanker going through the Straits of Hormuz at the moment? Bearing in mind that Iran has said they will attack anybody passing through, and they have indeed already attacked one tanker. I don't know if there's, I presume there's an oil spill with that as well. So Brent crude has been rising. It's $84, and some people think it will easily go to $100 a barrel. And that has the effect of making costs of doing all kinds of business more expensive, because most kinds of business involve some form of transportation. And so if your cost of lorries and electricity and or whatever you're using for your transport, airlines, whatever you're using for your transportation is going up, that has the effect of reducing your profits. So it is possible we see a slowdown in the economy because of this. Having said that, we've got a lot more business than the 1970s, which is, let's say, virtual and not dependent on the price of oil at all. So it's not a dead certain that we go into a slowdown, but obviously we will go to some extent slower. We've got some other factors going on in the world with major oil producers, China in particular, which has ordered its top oil refiners to suspend exports of diesel and gasoline for the time being. So they're prioritizing domestic consumption to make sure they've got enough in the country for the time being. And in other countries, they know that they probably will be less oil for processing coming in. So I've seen that Japan, Indonesia, and India are reducing their refinery rates and are suspending also fuel exports. So there's a kind of a lot going on with different countries trying to secure their own supplies, and that will have an impact on the countries which are net importers of fuel and oil.
Yeah, and some people think this could be worse than COVID when they shut everything down because energy, I know like a lot of stuff is done virtually now, Clive, but you can go on Amazon and do your shopping, but they still need to deliver it to you and they need a delivery van and it costs to drive the van. So yeah, I think the also I just showed the Brent crude price there. It looks like it's taking off, and I think it's been quite how can I say under control. I would have expected that last Sunday when the markets opened that it would be a lot higher. And I actually think U.S. Treasury is saying that they're going to look into trying to control the price of crude through the futures. I think they're doing that already, and they're just saying now that they will do it. I just find it really strange that it stayed quite subdued.
I
And
mean, I don't see how they can control the price. So, I mean, how can they control the futures price? What are they going to do? Sell futures that sell oil that they don't have? I mean,
well, that's what they've been doing with gold and silver for decades, but eventually,
yes.
yeah, eventually it doesn't work out, right? You can, in the short term, you might drive the price down, but it's a fool's game, fool's errand, I think.
I mean, at the end of the day, whoever is trading in the futures market of oil and gas, I presume that they are expected to lay their hands on oil and gas somewhere. And if they can't get it from their traditional sources, they're going to turn to the futures exchange and say, we'll take delivery. And then someone, if it's the US government who's shorted it, they're going to have to scramble to find that oil.
Yeah, yeah. So here, yeah, here's the story. And as I said, I think they're doing it already. It came out. I mean, it came out yesterday, but it's come out U.S. Treasury Department here saying expected to announce measures aimed at combating rising energy prices. Yeah, so how long do you think this war could go? I know that's a difficult question to answer. Any
Well,
thoughts?
I think I'll go with the official stance that it might be a month or two. Um, that's I'm sorry to say. I know there's a
Yeah,
lot of
yeah, I
opinions
know.
that it could be like the First World War,
No,
where they said it
no.
was going to be a month or two, and then it lasted 5 years.
Yeah,
Um, but I'm going to go with the official stance of a month or
yeah,
two. And, but I'm always the optimist, Mario.
yeah. Anything you're seeing that you think is interesting that people should know in the markets or like in precious metals or the miners?
Well, the one thing which I think is coming up is the first, sorry, not the first, the end of year results from many gold mining and silver mining companies. That will be a quarter where the average price, that's the average price to the end of December, was significantly higher, about $1,000 higher, or $2,000 higher, something like that. Well, $1,000 higher that quarter than the previous quarter, and the coming quarter that's the one to 31st of March. We'll be looking at a price of perhaps $2,000 higher than a year ago, which means that those mining companies will be making $2,000 extra per ounce of gold that they took out of the ground in the last two quarters, in the quarter which has just finished and the one which is we're in the middle of at the moment. So what that means is that the reported results as they start to come out are going to be significantly higher revenue and significantly higher profit for the majority of gold and silver mining companies. In my opinion, based on my maths, I think that makes the whole sector relatively undervalued compared with the profits they're going to be reporting over the coming, let's say, the coming 12 months. That's assuming the gold and silver price stands still, which is not my opinion. I think we're going higher.
Yeah, and when are these results coming out for the fourth quarter, Clive? When they,
So some will be out already,
yeah,
but it's generally March and April when you see these results.
yeah,
But some one or two might have come out in late February, but mostly it's going to be March and April when you get the majority of the results, and then you'll get the March results to 31st of March. They'll be coming out in maybe one or two in late April, but mostly May, June.
yeah. I mean, last year gold went up 64.72%. I've got my numbers here. And the GDX went up 142. This year, gold is what, up 18%, and the GDX is up 18%. So it looks undervalued, doesn't it?
Yeah.
And silver last year was up almost 150%, and the SILJ was up 163, which I think it's undervalued because it should be a multiple of silver. And this year, SILJ is up 25%, which is a little better than the 17.6% that silver is doing. So I agree with you. The not just the gold miners, but I think the silver miners are even more undervalued. Wouldn't you say so?
I've done some maths on a few of them, which this was a few weeks ago, and I came to the conclusion that the upside was pretty tremendous.
Hmm.
But that obviously
That's a good adjective.
there's two sides to this. One is the way the profits are going to go, which that's like a dead cert. The profits will be higher. And the other one is how the market is going to react to that and how the analysts are going to react to that. Um, Analysts are probably going to be a little bit cautious, so they probably will be factoring in an average price which is reflecting a number below the spot price. So if the spot price, let's say, is 5,500 on gold, or let's say $85 on silver, they'll probably be looking at when they project their forward profits, they'll be looking at perhaps 4,000, 5,000 on gold, and maybe 75 on silver to be
Yeah,
cautious. But those numbers will still look very, very good as projections. And I think that will result in a higher price target. And I think it will, down the line, when the numbers come in as expected, I think the prices of those mining companies will move ahead. Obviously, that's not supposed to be investment advice. It's just my personal opinion.
yeah. No investment advice. I was watching the markets the last few days, Clive, and the prices just moved around so quickly, and like as if the liquidity was really low. I've seen that U.S. Treasury yields they've gone up since the war started, and you usually would expect safe haven flows. So, do you think there's a risk of a liquidity crisis like we saw in March of 2020? And how would that impact? I think it's already kind of impacting gold and silver and the miners because we're seeing a bit of a correction. But do you think that that is with the war going on, that investors are kind of underestimating the risks, and we could all of a sudden see people really sell everything? And yeah, what's your view on that?
Well, definitely people are underestimating the risks because unless it's affecting you at your back door, you tend to think that's somewhere else. So it will always be the case that the risks are underestimated. But just because the risk is there doesn't mean to say it's going to happen. So we have to distinguish between risk and probability. There is a risk that my house might burn down, but the chances are it won't. But there's a cost to that risk, and that cost is I've got to pay insurance. And likewise with stocks, there's a cost to the risk that they might be severely affected, and the insurance you have to pay is you sell some of those stocks to reduce your exposure. On the treasuries, Mario, we've seen a rise in the yield since the war started on the 30-year treasury. It's gone from 4.62 to 4.72. That's unusual behavior because when people are worried because of a war, normally they rush to the safest asset on the planet, which is perceived as being US treasuries, and that yield should have dropped by several basis points, but in fact it rose by several basis points, which is an odd thing to happen, which I guess what it proves is people are not rushing to treasuries as they have done traditionally. They're looking somewhere else.
Yeah, am going to bring this up. This is the 10-year yield. So the war started, I think, here. Yeah, I mean, this
Yeah,
is
right there.
well, it started the Saturday before the opening on Monday,
It's
and
gone from 395 to 415. That's 20
390.
basis points.
Yeah, that's quite a big move. Yeah, so there you go.
It should have. I mean, it should have done the opposite. It should have gone down,
Yeah.
i.e., as people rushed to the safety of treasuries.
What about the political aspect of it that America's non-allies who hold a lot of treasuries are going to be even more skeptical about adding on, and they might even start selling off, and also a lot of the Gulf countries in they're getting hit hard against Iran, and they seem to be, yeah, not very happy with the protection that they're supposed to get. That's supposed to be the whole reason for the petrodollar, is that if those countries there get attacked, the U.S. will help them, and it doesn't look like the U.S. is more concerned about helping Israel.
No, at the end of the day, the world is definitely not the same place as it was a year and a half ago in terms of the stability or certainty as where we stand. I think we're now in a more uncertain world than we were a year or two ago, despite the fact the Ukraine invasion was ongoing. But things have moved up a notch now. In an uncertain world, what you have to do is have more diversification of your assets. And obviously, the biggest asset on the planet is US Treasuries in terms of government holdings. And I think around the world, they will be looking at saying, well, do we want to be totally exposed to one geographic area, United States? Shouldn't we have a bit from Australia, Europe,
Yeah.
Canada, and so forth. So I do think there's going to be diversification. And of course, gold will play its role in that. Whilst I don't think they're going to en masse say we'll sell half our treasuries and put all of that into gold. That's kind of not the way. They don't make those dramatic moves like that. But I think the direction of travel for gold will be increased holdings in the central banks, and that's going to be underpinning the price quite nicely.
I agree, and I think individuals and financial institutions should be doing the same.
Oh, they've
And
only just started. I mean, they barely started, Mario, barely started. I mean, I'm seeing, I did send you something from UBS who just come out with a statement saying that they were making, I think it was $6,000 projection on gold, which was quite nice. But I think their gold holding is still quite low in the discretionary
yeah,
portfolios.
yeah, and I saw that the percentage of gold holdings to central bank assets still just 3%. And I think in 1980 it was 50. And if we go back to the 1980 level, gold would need to be at $25,000. So anyway, Clive, any final thoughts for the viewers? Any interesting videos you've made that they should know about?
Nothing, no, I've got nothing special. But anyone who'd like to see what's going on with my videos, have a look at my webpage, clivethompson.com. And I'm working on a series of children's books which have gone to Amazon about Little Trot learns to invest, Little Trot learns to save, Little Trot suffers the great financial crisis, things like that. Which is for parents, but it'll be a while before those are out. And there's a couple of videos I put on my website which tell you kind of what's coming in that area. But I think the main thing is we've got a lot going on in the world. If you're going to make any moves, make them very gradually. Don't rush into anything. So you don't want to be you don't want to feel that you're the last fool who bought just before the stock market collapsed or bought gold just before it went down. Do make your moves gradually, and the direction of travel should be one of away from the technology sector. It doesn't mean exit it; it means reduce a little, and in the direction of the commodity sector, increase a little. And in that commodity sector, you should definitely be exposed to gold and silver, including the physical.
Thank you, Clive, and have a great weekend.
Thank you very much, Mario, and thumbs up to everybody. Bye bye.